As of 9:45 a.m. Eastern Time on this Monday, November 3rd, 2025, shares of Rezolve AI, trading on the NASDAQ under ticker RZLV, are in the middle of a very active session. The stock is currently trading at $4.75, which is up 31 cents or nearly 7% on the day. This isn't a quiet move. The volume is already massive, with over 10.1 million shares changing hands, putting it on pace to easily surpass its already high average daily volume. The stock has been trading in a tight but volatile range this morning, moving between $4.52 and $4.84. This is a name that is clearly in play today, and the price action suggests a serious battle between buyers and sellers. Now, the expectation for a stock like this, a recently public AI company with a 52-week range that swings wildly from $1.07 to over $8.45, is that it's just another cash-burning hopeful in a crowded field. The immediate reaction is to dismiss it as speculative. But the reality of what's happening just under the surface is far more complex and forces a complete reevaluation. The reason this stock is a war zone right now is because on October 1st, just about a month ago, this company didn't just meet expectations for its first half 2025 results, it posted staggering guidance. Rezolve Management raised its 2025 annual recurring revenue, or ARR, guidance to a minimum of $150 million. Not only that, they initiated 2026 ARR guidance at a $500 million exit rate. This is an enormous claim for a company whose first half revenue was just $6.3 million. This guidance is the central point of conflict. It's either the single most undervalued projection in the AI space right now, or it's a house of cards. Let's establish the common ground, because we're all seeing the same thing. Investors are absolutely desperate to find the next big winner in artificial intelligence. We've seen what a few good contracts can do for other AI-related stocks. The general belief is that RZLV is one of these lottery tickets. It's a B2B AI commerce platform. It has AI in its name, and it's making big promises. Most investors look at the PE ratio of -6.65 and the net losses and assume it's just another company lighting cash on fire to chase a trend. They see the volatility, the 7% pop today, the 10% drop last week, and they treat it like a casino table. But here's the challenge to that thinking. What if the market is fundamentally misinterpreting this company? What if this isn't a speculative Me Too product, but a high-growth infrastructure play that is actually signing the contracts it claims? The company's entire narrative is built on the idea that its partnerships with giants like Microsoft and Google are not just simple marketplace listings, but deep technical integrations. They are telling the market that their proprietary brain power large language model has achieved zero hallucinations, which, if true, is a massive differentiator for enterprise clients who cannot afford the creative errors of public models. This tension, this gap between the company's spectacular promises and the market's deep-seated skepticism is fueling the fire we're seeing on social media and in the trading data. The online investing communities, particularly on Reddit and X, are completely torn. On one side, you have threads filled with excitement, calling RZLV an undervalued AI play and a 10x rocket, pointing to the 426% year-over-year revenue in the last report and the analyst price targets that sit around $9 or $10. On the other side, and this is where the frustration is boiling over, you have a very vocal, very organized bear camp. These investors are pointing to short seller reports, specifically from names like Fuzzy Panda Research, which allege the company has major liquidity problems. There are active discussions warning investors to be extremely careful, with users posting detailed arguments that the company's guidance is impossible. They ask, how can a company with $6 million in first-half revenue credibly claim it will exit 2026 at a $500 million run rate? This is the core of the doubt. This isn't just retail investors venting. This sentiment is being driven by some very specific, very troubling accusations that are circulating. The bare thesis on Reddit is that the CEO's previous company, Pawa, was a train wreck, and that the current business model is a con. They claim the partnerships are just PR, alleging RZLV is paying Microsoft for the privilege, not the other way around. This skepticism was amplified in late September, when the company filed a Form F3 registration statement. Immediately, the bear camp screamed dilution, claiming this was a setup for insiders and early investors to dump their shares on the market. The panic was so significant that on September September 29th, Rezolve had to issue a formal press release to fight back. The company stated unequivocally that the F3 was not dilution, but a simple administrative re-registration of existing shares from an older, more burdensome F1 form. In that same release, they forcefully reaffirmed their strategic partnerships, practically daring the market to call their bluff. This is a company actively at war with a short seller narrative. This battle isn't just theoretical, it's visible in the institutional filings and short interest data. Retail investors on social media were quick to point out that major hedge funds, including Citadel, were listed as shareholders. Then other threads popped up claiming Citadel was selling off its stock to lock in profits, which fueled even more panic. Whether that's true or just a rumor, the fact is that the short position on this stock is substantial. Fintel data shows about 11.5 million shares are currently held short, representing a significant 7.73% of the float. The cost to borrow these shares has been elevated, recently hovering in the 11 to 15% range. This isn't a casual bet. This is real conviction from bears who are paying a high price to wager that this stock is going down. The 10 million shares traded so far today, that is this war playing out in real time. The bulls buying into the $500 million guidance and the bears shorting what they believe is a fantasy. So, removed from the noise, what does Rezolve AI actually do? This is the part that gets lost in the shouting. Rezolve AI is a B2B company. It provides an AI-powered platform called the Brain Suite to enterprise-level clients, primarily in retail and e-commerce. Its products are Brain Commerce, which handles AI-driven search and personalization, and Brain Checkout. This is all powered by their own BrainPower large language model. The company's main revenue streams are subscription-based and transaction fees. This is where the bull case gets its legs. This isn't just an idea. The company's H1 2025 report, the same one with the huge guidance, beat expectations. It posted $6.3 million in revenue, a 426% jump from the prior year. More importantly, its gross margin was 95.6%. That is an astronomically high software pure margin. It means that if they can scale, the profitability could be immense, and they have customers. They claim over 100 enterprise clients, and they're not hiding them. They have publicly named clients like H&M, ASOS, Ferrero, Office Depot, and Urban Outfitters. They also have a $9.8 million annual contract with Liverpool, a major Mexican retailer. These are not small phantom clients. These are real global brands. But, and this is the critical but that the bears are right to focus on, the financials are also a source of extreme risk. While the revenue grew and margins were high, the company is burning cash at an alarming rate. The H1 2025 report showed a net income loss of $28.93 million. Its total equity on the balance sheet was negative $14.29 million. This means its liabilities are greater than its assets. This is the liquidity problem the short sellers are talking about. Rezolve AI is in a desperate race against time. It must convert those blue-chip customers and its pipeline into the massive ARR it has promised, and it must do it before its cash pile runs out. If it fails, it will be forced to raise capital, which at this price point would be highly dilutive and would prove the bear thesis correct. The entire story hinges on execution. Comment below if you think Rezolve can actually hit its $500 million ARR target for 2026. This brings us to the future outlook, which is the very definition of a high-stakes binary outcome. The expectation for the bulls, who are buying the stock up 7% today, is that the guidance is real. They believe the 95.6% gross margins are the true story. They believe the 100-plus enterprise clients like H&M are just the beginning, and the analyst targets of $9 or $10.79 are not just possible but conservative. They see the short sellers as market manipulators who are about to get caught in a massive squeeze. The expectation from the bears is the exact opposite. They believe the guidance is a fantasy, a desperate puff piece from a management team with a questionable track record. They believe the company is hemorrhaging cash, that the F3 filing is the smoke before the insider selling fire, and that the stock is ultimately heading back to its $1.07 low. The reality is that both sides have a point. This is one of the purest high-risk, high-reward plays in the AI sector today. The company is burning cash at an unsustainable rate, but it also has industry-best gross margins and a client list that any B2B startup would be envious of. The story isn't about the AI hype, it's about cash flow and contracts. The key catalyst to watch will be the next earnings report, though the company frustratingly only reports semi-annually, so we may not get a full update until April. In the meantime, any announcement of a new major enterprise client or any new validation from Microsoft or Google could send this stock flying. Conversely, any sign of an equity offering, any news of a major client loss, or any significant insider selling will validate the bears and could collapse the stock. Today's 7% pop on heavy volume shows that for now, the bulls who believe in that $500 million target are winning this specific battle. The expectation is that this is another AI hype stock. The reality is that this is a high-stakes bet on whether a company with real customers and real margins can outrun its own balance sheet.